Disclaimer. This material in this presentation has been prepared by ADCM, LLC DBA Willow, and is general background information about Willow's activities, current as at the date of this presentation. This information is given in summary form and does not purport to be complete. Information in this presentation should not be considered as advice, or recommendation to investors or potential investors, in relation to holding, purchasing or selling securities or other financial products, or instruments. Neither the information nor any opinion expressed herein constitutes an offer or a solicitation of an offer to buy or sell securities. Before acting on any information, you should seek independent financial advice. All securities and financial products involve risks. While due care has been used in preparation of this presentation, the information contained herein has been obtained from sources believed to be reliable, but its accuracy and completeness cannot be guaranteed. Forecasts and hypothetical examples are subject to uncertainty and contingencies outside Willow's control. Past performance is not a reliable indication of future performance.
We always start with the risk indicators. We see that there's a lot of new people who've joined us on this call. So again, that's just like an overview. Yeah, we look at risk indicators. Then we want to look at leading indicators. So risk indicators give an indication of how much risk there is in the market for recession, for defaults and things like that. And then we look at leading economic indicators that gives an indication of where things are going forward. So we'll give you that information first, and then give you an idea of what we think is happening here.
Right.
So let's start. Right.
Yeah, and after that, we'll go into some charts that we find interesting, a couple of charts just on the general market, and then we open it up at the end to answer your questions. We have several that were submitted beforehand, but feel free to type it into the chat too at any point, and we'll try to get to it.
Yep.
So volatility, right, VIX, this stuff just measures what is the implied volatility in the market, meaning how drastic are the moves thought to be over the coming month. When you see these when you see these lines go up, there we go. When you see these lines go up and to the right here, it's basically saying that there is more uncertainty in market, and market participants are expecting prices to fluctuate with more frequency and bigger moves.
Right, and so the lighter line, so is fixed income volatility, and the lower line is equity volatility. And this is a proprietary index, the volatility averages. So this combines a bunch of different indicators we look at for volatility. When we see these things, it's very interesting because you're going to see here that the volatility index for the equity market has been pretty benign, which is really odd. We're not buying it for some reason. It's not showing what we think is the true swings that we see in the market. But what does capture our attention here is what's starting to happen in the fixed income market. So up to this point, we've been more concerned about just a general recession, which we've been concerned about for a while, for those of you who have been following us. But now we're starting to possibly see something creep in where we may start to have some issues with credit itself. So if we have issues with credit, then we'll definitely become even more conservative than we've already been.
And remember, the bond market's how many times larger?
Oh my gosh, I don't know, 10 times larger. We have a banker on here who would probably know better than we do, but it's
so
significant.
It's important to pay attention to what happens in those markets.
Yeah, it's significantly larger than the equity market. Okay, let's go forward.
All right, so credit default swap spreads. So these are basically insurance on whether a company is going to go bankrupt or not. So when you see these spreads go up, it's saying that the cost of that insurance has increased, meaning that the chance that the underlying company will go bankrupt has also increased, right? It becomes more expensive to buy that insurance. And we're seeing all of these across investment grade, high yield, and emerging markets all increasing.
Yeah. So, and not at levels that are significant, but the slope of this curve here, can I get this? Is the mouse not working? Is it me? Okay, here it is. So the slope, it's always about the slope of the curve rather than just the raw number itself. So this slope is not something that we like. We don't like to see a direction in this form.
Right, and you can see just since January, December, something changed, right? Yeah. Whereas markets here were these spreads were all relatively flat up until that point. Then something changed and they started to tick up.
And of course, so you know the Fed is in a period where they're raising rates, obviously. So now what happens, so you know, of course, more risk is going to come in the higher the rates there are. There's going to be more risk of potential default because as these loans begin to reset, the cost of your funding goes up. So if I have a floating rate, let's talk about mortgages, but if I have any floating rate corporate debt, my cost of funding goes higher. So this is why you start to see the potential for default would raise, and it would make logical sense. This chart's just different. Oh yeah, so we break it down so you know. So what you're seeing is like an overview of all the data that we look at. But what Paul pulled in here is just looking at the credit default swaps for many different individual companies, which is what we do as well. And understand that this, along with, we have credit spreads in here too. These specific charts are the ones that when I was during the financial crisis, these specific charts are the ones that made us get out of, or made me get out of, like the Lehman bonds and the Fannie Mae preferreds and Bear Stearns, for example. So these very specific charts, and we're not there yet. Okay, it may look like it because you have this data here that's, you know, relatively flat. Again, this slope is what bothers us right here. If this were to continue, then we have to really ratchet in pretty significantly. But this breaks out company by company, which we do for our companies that we hold in the portfolio.
Right. This chart was really just to illustrate, you know, taken from the top 25 holdings of the S&P 500. How is what are the credit default swaps of those companies? And they're starting to rise.
Yeah, this is interesting, Paul. Which one is what company? Is that Verizon or is that Procter & Gamble?
That's Procter & Gamble.
So this is really interesting. You know, that's what I was trying to notice this morning, whether this gray chart was Procter & Gamble. So what we would then go with here is we'd have to believe that Procter & Gamble's definitely having some problems with their supplies. This is what this is telling me. So now what we have to do is we have to do our research, see what's going on there, because this would be a holding that we'd have to be very concerned about, because that slope, that actual number for a blue chip company is pretty significant. Yeah.
And it's just continuing to watch to the trends. If this starts to flatten out a level, it's an okay sign. If it continues to go up or it increases that curve up, that's a warning.
Yeah, so for those of you who've been following us for a while too, you know that we've had concerns about supply now for well over a year. We actually think the supply issues are going to get worse, not better. So this is not something we think is going away. So a company like Procter & Gamble that does rely on a lot of their resources from China and some of these other areas, it would make sense to me that they may have be coming under a little bit of pressure. Bond spreads. Okay, so this is, I'd say, the most important data point for fixed income that we could possibly look at, because this number cannot possibly be manipulated in any way. This is the actual trades that are taking place. What this tells us is the amount of risk there is in a particular holding. So what you see here is just the credit quality, different grades, right?
So this is the spread between the U.S. Treasury and then different tranches of investment grade bonds, from AAA rated to AA rated, and so on down the line. And when you see these spreads widen, it is a pretty solid measure of risk, perceived risk in the markets, because it's no longer, the spread between the two is no longer low. As that blows out, it's saying, okay, I have to take on this much more risk to invest in these corporate bonds as opposed to sticking with the Treasury.
Yeah. And so this isn't enough to say that we're going to have credit issues, but it's enough with when you overlay everything that's going on, the rapid ascent of interest rates, which we don't think is over, and we think we are of the belief that no matter what the Fed does, it's going to be hard for them to tame inflation, because we have a lot of structural issues that have changed, which we'll focus on in a little while. But this is not enough for us to say we're out, but it's definitely, it's something we want to see if we want to be out of some of these things. So this is again,
This looks, instead of looking at a tranche of like AAA rated as a whole, this then breaks it down by a specific sector. So it's looking at things like, okay, triple B rated bonds in healthcare, how are those spreads compared to the comparable treasury? And you can see everything is trending wider.
Yeah, that's still not big enough, but it's again, it's the slope. And understand, because our work is top down oriented, we need to always look at our sectors, because this is what's going to tell us where we want to over and underweight. So, it's interesting, Paul, we don't have energy in here. Yeah, we'll have to pull that in. Yeah.
All right.
Sentiment.
Yes. So it was in the news recently, but consumer sentiment hit a record low that when this indicator first came out, I believe it was sometime in the 1970s. Today, recently in the past few weeks, it had hit a new low. So not in the great financial crisis, not in the 87, the dot-com boom, or the dot-com bust, everything before that, consumer sentiment had never hit such a low. So that's a very telling sign.
Yeah. I mean, it smacks to, I think, what we are all experiencing. So all is not well. We know this. We don't have to tell you. You feel it yourself. And it's not just you. It's us. It's the average consumer. And what we're seeing is this is not just hitting the lower income. It's hitting every class. And it's now, it hit the middle class, and now it's hitting the high net worth, and especially now our retired people, like who have a good amount of money, but it's also hitting them in a pretty significant way.
Right.
And
inflation affects everybody, regardless of class status, whatever. Everybody is impacted by inflation. Recessions, maybe you could argue, only affect people without jobs, or those struggling more or disproportionately by inflation. Everybody.
And there's a lot of discussion right now on Wall Street about whether the Fed was behind the 8 ball and so on and so on. But understand, the places that we're seeing inflation, we've been talking, and again, for those of you who've been listening to us for a few years, I'm sorry we're repeating ourselves, but we have to do this. Where we see inflation is in the necessities. It is in
stuff you need to live.
Yeah, it's in food, it's in energy, it's in healthcare, it's in taxes, right? It's in fees, it's in rent, it's in the cost of housing. How can the Fed actually control those things by raising rates? That's what we have a concern about. Yes, discretionary spending, this makes logical sense. And yes, if we see a major slowdown in the economy, one would think that energy prices would come down, but we're up against a very different situation right now. We're up against a very different situation, not only global unrest, but also policies that have been put in place that have made it such that we went from energy independent to energy dependent. We were energy independent for a very short period of time, and now we're energy dependent. So there's policies, and then there's the wars that are occurring overseas that are creating this issue. So how the Fed could really affect that, this is beyond economic. This is beyond economic. This is beyond
raise rates
over
and artificial, stamp down demand, but because nobody can afford anything, rates are just too high. But
so this basically is beyond economic. Like, this does not have to do with an over excited economy. Okay, it would make sense to raise rates. You have an overexcited economy. You want to slow the economy down, but that's not the case here.
Yeah,
this is a structural change.
You could argue, for the past decade, rates should have been increased incrementally many times over the past several years. It's ridiculous that they weren't. It was a really solid example of kicking the can down the road for political reasons, for the most part. Back in the 70s, 80s, inflation was going, early 70s, inflation was going crazy. Volcker rose interest rates by 20% almost overnight, forced a recession. He was hated for it could you imagine the Federal Reserve doing that today?
Can't do it now. So there's a big difference. And this is the other thing. They cannot do it now because in the 70s, we did not have the debt that we have today. So if the Fed actually raises rates that quickly, you have to understand, we could look at, I'm going to say it, we could look at a default in our treasury. It can happen if they move rates that quickly. And because, right, we have to pay back the debt.
Right?
So what happens is
Uncharted territory.
uncharted territory. If this is what ends up happening and our funding goes up, you have to know that you will see our taxes go substantially higher. They would not have a choice or face default. So right now, not to be pessimistic, but unfortunately, the worst case scenario that we were seeing in our work is becoming more potential reality.
There's certain aspects that are playing out, unfortunately.
So frustrated. I wish I could just change this overnight. I wish because we can see it, we can change it. I don't know about that.
Or if there were tools that we could invest in that really capitalized on some of those trends. Right, so here's the inflation chart. We really appreciate Shadow Statistics' version of this because it looks at how they used to calculate these things originally before they started tinkering and changing and removing key elements of these measures that, in our opinion, provide the true metric of how does the everyday consumer feel inflation. And you can see that based on the 1990s equation, real inflation's what, 12% or so. It's well over 10%.
Yeah, so if they never changed the basket.
Right, if they never changed the basket. The official CPI numbers are around 8%, which is still historically quite high.
And Paul, remind me, what percentage of the CPI reported by the government, what percentage of that is representative of rent? Do you remember? Housing? 10%?
10 or 20.
10 or 20%, is that your experience? Because I don't think it's most people's experience. So that's why we like this number, because it's more representative, I think, of the real experience that people are having. All right, okay.
Here was an interesting chart we wanted to share. It just shows consumer loans from credit cards or other plans from banks as the blue line, and then the personal savings rate as the red line. And when COVID originally hit, people weren't spending, right? And all these and there was the stimulus checks that went out, and a lot of people saved that money. But as you can see, since I don't know, early 2020, savings rate has gone down, and the amount of consumer loans has gone up. So unfortunately, it may seem like a lot of people are able to weather the current inflation rates, but actually it's only possible through taking on more debt.
Right. More debt. So this is the, like, I have this, I'm taking this cursor here to show you what the debt looked like in 2018. And we were talking about how levered we were back in that time period. And then of course the Fed lowered rates considerably, quantitative easing, so on. We took on a lot more debt, as you can see here. And then, of course, now the debt is significant. This is mostly, so you know, credit card debt. So it's not, So,
all right.
Recession risk. Okay, this is the risk of recession. Now they're finally, Wall Street's finally catching up to what we've been saying.
These are surveys that they put out there occasionally. They're saying recently, their surveys are saying that recession risk is thought to be around 75% or so currently, as opposed to beginning of the year back in January, where they were saying it was close to zero. This is something that we've
so again, for those of you who are with us know that we've been net sellers of the market since October, because the markets, if you remember, the market is the leading economic indicator. It leads, it shows the way. The market was already showing us last year, October, November, and then solidly by December, regardless of it hitting a new high, right? Regardless of it hitting a new high, because we don't care about one data point. We care about all of them. So we were seeing that the sectors underneath the surface were clearly showing three things, really. We took an energy position summer last year because it was showing that energy prices were going higher. We took the charts were also showing that there was a potential war in the offing by the end of the year last year. That was
And you
clear.
can see that through tracking data on defense companies.
Yeah, not just defensive companies, but also like
energy costs, fuel,
exactly,
jet fuel specifically.
Yeah. And then what was the third thing, Paul, that we saw then? We took the energy. There was one other thing that we were, we were getting out of high beta stocks. So we were like taking risk off the equation, because if we have a moment, we can show you maybe some of the charts there. I don't know if we do, but you can see that there was this steady deterioration in these charts in the third to fourth quarter of last year. The market is a leading indicator. So the market was showing us we were in this direction. Wall Street's finally catching up. So hopefully this means that it's getting close to, I don't know. I want to say it's getting close to an end. I don't know, but I can't say that with confidence.
So this is just another point, we're really hammering this down. This is the Philadelphia Federal Reserve's business outlook. It's a survey that they run for a whole bunch of businesses in their region to see what's their outlook. Is it positive or is it negative? As you can see, since post-COVID, the initial COVID was those big red candles here, but we've just hit the first negative one here. So all of this stuff is starting to catch up with people and markets. So just something to be aware of. And then back to one of our other points, we're always talking about the dollar as one of our long-term trends. I mean, we've been talking about this for over a decade, just about how long-term the dollar's standing in the world is under attack and under threat, arguably through poor policy or a whole bunch of reasons. But here's one more data point to sort of throw some more fuel on that fire, is that China's treasury holdings, so how many US treasuries does China actually hold, has just hit a recent low.
Right. So you have to remember, we need countries to support our treasury, because if we don't have people buying our treasury, we can't run, we're unfortunately a debt oriented country. So if no one's buying our treasury, or the treasury starts to dry up, then what you're going to see is that we have to raise rates even more to attract debtors to come to the country. So this isn't this is not like, we would want to look at how other countries are looking at us, but you can see like India has less. Across the globe, you can see less and less.
Being the world reserve currency, you would expect this to go the other way.
Yeah.
You'd want to see more countries saying, okay, we have a lot of faith in the United States, and so therefore we're very comfortable holding a lot of their debt.
Yeah, and then to point something out. So you have to remember the United States in the past, and let's just say in the current day, but we think it's in the past, we were looked at as the safest place to keep money. So that's where, whenever anything hit the fan around the world, countries would come to the United States and buy treasuries, and they would buy our dollar. So you can see here, I wish we had the dollar chart, but we don't. It's just treasury. But you can see from the beginning of the second 2 decades ago, treasuries, the holdings go down. Now, when the financial crisis hit, you see that China went and bought some of the treasuries. So they wanted a safe haven, even in this financial crisis. But after that, you can see with each crisis, so, okay, COVID hit, they bought us. But now we're in another crisis, right? There was a war going on. They're not buying us.
In our last presentation, you can go on to our website. We have
a dollar chart.
Our May presentation, we do have these dollar charts that show over time, and we do talk about it in more depth there about how with each crisis that happens, that flight to the US dollar becomes less and less.
Now, it's fair to say that right now the dollar is rallying. Okay, right now the dollar is rallying, but it doesn't look. It's not a convincing rally. Maybe the next call we'll update that.
All right, just wanted to show a quick couple market charts. This is the S&P 500 year to date, is down about 20%, sort of stuck in this technical range here. Downward channel, strength decreasing. Do you have any other things you want to add? It seems pretty straightforward.
No.
And then here's a zoomed out view of the 5-year chart. So you can see markets just sort of hit an inflection point here at the end of 2021 and have just sort of been trending down, stuck in this range.
And again, if you look at, if we had our individual charts in here, you would see that the market was already, in our work, was already breaking down. Didn't matter, it was hitting this new high. Didn't matter. And, we know that some of you have experienced greater than average capital gains last year. But this is why. What's happening right now is why, because it was telegraphing that we would be in this position today. So again, doesn't matter what the overall market was doing. Okay.
We wanted to pull this slide. This is a slide from our presentation back in October 2021. It's a great presentation. If you have time, go back on our website. You can go to the investwithwillow.com/insights and scroll back to the October-November period for the what keeps us up at night presentation, because a lot of the stuff we've been talking about is really unfolding.
Power consolidating to the top, so larger corporations, and then even more important, and this smacks to the very last point, which is civil unrest, is you see that wealth is very much consolidating to a very few, and even high net worth people now, you're feeling this. You're feeling the gap is absolutely widening, and that the power consolidation to the top is destabilizing. That leads to civil unrest, in our opinion. It also, high prices lead to civil unrest. We're already seeing that. High debt, you can, the chart that Paul pulled in showing credit card debt to live is
right. That plus corporate debt too. I mean, not only on the individual side, where it's always a scary situation when people have to take on debt just to survive, but then also on the corporate side, where as we're seeing rates continue to increase, at some point that plays back into servicing their debt, which becomes more and more challenging, which can lead to layoffs and restructuring and bankruptcies for many companies.
Yeah, and I mean, I think also important to note that there's a lot of high debt now at the government level. That's also, I don't like that. You can see that in our own treasury. Supply chain disruptions, right? I mean, this is not something we think is going away, particularly because a lot of the tension in the global markets are just increasing, not decreasing. And stagflation. So we're finally hearing Wall Street talk about stagflation. That is the worst thing you can see for them.
Yeah, I feel like we've talked about that since I started working with Alexandra 12 years ago plus. So
that we were heading in the direction of stagflation, like reverse, what do you call it? Reverse stagflation. I can't even remember exactly where. Again,
wages flatline and the cost of everything continues to go up.
And especially the things that we need, not the discretionary items like clothing and such like that.
Yeah, TVs have gotten cheaper, but you can't eat a TV.
Right. Anyway, so then civil unrest, obviously we're starting to see some indication that things are getting a little bit more tense. And like what Paul and I always say, what do we say, Paul?
Yeah,
don't look at
each other, right? Look up. Who's pulling the strings? Who's setting the policy?
And please understand, it's bipartisan. This has nothing to do. We don't care about it's not about one specific person. It's literally about the policies that are getting put in place that are actually creating, we think, some more issues than less overall. Okay. Ready?
All right.
Questions?
So let me unshare my screen.
Okay. While he's unsharing, we did have some questions already written in, so let's get to some of these right now. Do you believe lower price to earnings multiples and lower earnings forecasts are a sign of lower stock prices? Okay. So there's things called leading indicators, coincident indicators, and lagging indicators. So leading indicators are some of the things that Paul and I were talking about today. Coincident indicators are indicators that are happening simultaneous as the event occurring. So now what we're starting to see is companies are coming in with lower earnings. Okay, we expected this. The work showed us this. Do we think it's a sign of lower prices? It's not the only, it's not, because it's not a leading indicator. That's not the one thing that would tell us that prices are going lower, right? It's not the one thing that, it's all the other stuff that we look at that would tell us that. Because it's always darkest before dawn. And what that means is you'll see really bad earnings at the point where markets are starting. So it's not something, does that answer the question? You think?
Yeah, and earnings have really just started to show some signs of stress. A lot of the increases in energy costs have yet to be reflected in new earnings calls and reports. And that should start to show its head over the next several months. So we'll see how that all plays out.
Yeah. Okay. So then what do you see the biggest risk for the current equity markets? I would say the Fed overshooting. You know, I think the biggest risk is stagflation. The biggest risk is that the Fed cannot control inflation, and therefore we move into a stagflationary environment, which we have not experienced since the 70s. So I would say that's the biggest risk to the equity market. Yeah.
Let's say that there's several questions on cryptocurrency. So maybe we just
want to do that toward the end. Okay.
Yeah.
Are you worried about current growth in China and the health of the Chinese economy? So, you know, we started to see some bottoming in the data in China. So that, and you also have to know that they have been growing at a faster pace than the US for a very long period of time. So unless we see something changing in that data, so it starts to roll down to the, and right now, Paul, the charts are still slightly
it's
the
early, but you can see there's a consolidation, bottoming type process.
And a little bit more. So are we concerned about current growth? I think we're concerned about current growth everywhere. So this isn't like, this is, and one of the things, like, again, we're intertwined with everything. We are a global economy. We are not just a US economy. So yes, are we concerned about the health of China? Are we concerned about our relations with China? Yes, because we don't have a contingency plan in place so that if there's more issues with China, maybe they lock down, maybe there's just more political tension, where are we going to get our widgets for our manufacturing plants to continue manufacturing?
You may have heard of some onshoring happening, but it's such a small, it's so small that the impact of that wouldn't be felt.
It's too early. And you are hearing that Amazon is actually closing some of their warehouses because they don't have enough inventory. So are we concerned about China's growth? Yes, because we're really whether we want to know it or not, we're completely interdependent now on each other. And so, but what we can say is when we look at the raw data out of China itself, it is showing a bottoming process.
So you do this one?
Yeah, go for it.
Do you see any chance of a market rebound in the foreseeable future, or does the current trend continue? So we just look at the data and see what the data tells us. And right now, the data is telling us that caution, yes. Now, that said, there could be a relief rally, and we would not be surprised if there was some type of relief rally in markets because markets are reflective. After any big drawdown, there is always some type of mean reversion or return to the average, but don't be fooled.
Yeah, you know what, Paul, is there any way you could pull up the chart of the S&P? And when I said to you, so I want to say it was sometime in March, I said to Paul, now, Paul, don't be surprised, you remember this, if we have this big rally in the S&P 500, you're gonna question some of the decisions we've made. Hold on, he's getting into this, hold on. So, because what happened in March is we started to have a mean reversion rally. And when you have these mean reversion rallies, not to get too far into the weeds here, it's not uncommon for you to question like, oh, whoa, did we make the right decision lightening our portfolios? So
nobody can see it.
No one can see it. Yeah, okay. Let's see. So we want to show the March rally, right? So hold on 1 minute. He's going to get
this chart.
It was there, March. Okay, so yeah, you can put that in. He's going to pull this in so you can take a look at this because I want to show you. And I remember where I was sitting when I said this to him, and he remembers the day I said it to him because, okay.
Okay.
So here, can you get that chat box? Okay, cool. So show them where the March rally took place, Paul.
So the March rally was
Right there.
highlighter.
Yeah. So here it is.
Right here.
So probably right around there, if you can point there, Paul. That's when I said to Paul, now, Paul, don't be surprised if we have a mean reversion rally, like, and you're going to question all of the decisions that we made. Didn't you start to question some of the decisions?
Oh, we talked about it.
We did, but how did we not?
Right, and it shows this is a, a good 12, 13% rally in markets from the high there.
Yeah. So, I mean, that's a, look at, so that was the high, that was the all-time high, right there.
Right here.
Yeah. So we went down for 3 months. We had a mean reversion rally, and really, if we would not be doing our job if we didn't question everything we do, period. So we expected this, and we had to question, did we make the right decisions? It was clear because we're watching the tape, we're watching the details behind the rally itself. It was clear that even though that was happening, many things were breaking down.
Yeah.
So
why we don't take any one data point
exactly
at its face, we look at everything.
Yeah. Okay. Let's move on. So your question is, we see any chance of a market rebound? We see the chance of a mean reversion rally. We are absolutely due for one. And then any mean reversion rally, we would be more apt to sell. Why? Because the economic backdrop isn't making us jump up and down for joy. So that's where we are.
Should I pull my money out of the market and buy gold, or
let it ride?
I mean, this really is where having an active manager can help.
Yeah. We can't answer that question for you because it's very specific advice, and we're not allowed to do that for you.
It would depend completely on your time horizons and risk tolerances.
But and this is part of the reason why we don't believe in index funds, honestly.
Just passive management in general. Over super long time frames, maybe it works, but really, how can you time that with your retirement? It just doesn't.
Yeah,
the two don't connect.
Yeah. So do we like gold? Yeah, we like gold. Do you just own gold? It's not liquid. So there's that aspect to it. So yeah.
All right. What to do with extra cash?
Yeah.
We've always used cash strategically.
Yeah.
And so there is a time and a place where even if inflation is high, it still may make sense to just hold on to cash, at least in the short to intermediate.
Yeah, like so we've said this before. It's opportunity cost, right? Sometimes it's just better to stand still and wait it out. And we've said this now for 6 months, and we're saying it again. Sometimes it's just better to hang out and wait it out. And that's where we are right now. Do we like it? No. But is this and you have to understand, is this, no, we'd like to buy stocks. We want to be more involved in the market, but the fact of the matter is we're working for you. And, bottom line is what's going to be the best thing for you right now is to have a little bit more in cash. And then the follow-on question to this, is this a good time, bad time to launch a new business? Well, it depends upon what type of business that is. Is it something people need, or is it something discretionary? Is it a discretionary item? And are the input costs to whatever business that you are creating, are they export driven? I mean, import driven? Your input costs, if it's import driven, what region of the world is it coming from? You have to keep in mind shipping costs. There's all kinds of things. So it depends upon the type of business that it is. If it's discretionary funds, I would be apt to say not. If it's something people need, like we did, somebody pitched a business to us not too long ago that makes very good sense to us. That would make sense for that particular business because it is something that is needed and something that will actually help the situation in the schools. Okay, so to us, that's no brainer. But this, if it's discretionary, I wouldn't even think about it. Like restaurant business, definitely not. Yeah, especially like you have to keep in mind too, the input costs to farmers are going substantially higher because of fertilizer costs and things like that. So not so much restaurant business, definitely not. Are bonds, golds, and cryptocurrency covered? Yes, the answer is yes. That's definitely true. And so there will be points in time where, we want to be a little more in bonds, a little more in cash, a little more in other areas. So yep, that's part of it. Let's see. Did I miss something here?
Yeah, do this one. I guess.
Okay, so the question came in about commenting on our asset allocation thinking currently and into the coming months, where we want to be in terms of equity, fixed income, cash, alternatives, and things like that to ride this out. So within the equity market itself, we are very focused on the things that are needed and necessary. So like, for example, energy, food has been a big part, but even our food position, we're questioning because it's not
power.
Yeah, it's not the raw input. So like, most, I don't want to say, but there's a fertilizer company that's catching our interest. It just has a lot of volatility. But for example, we own some farmland, like a farmland holding. That's the raw asset. We like that. On energy, we like that. So within the equities themselves, we're going to be really focused on the areas that we know are going to do okay, or sense, like if you get into which we really know, we sense are going to be fine. In fixed income, we're always looking for the best quality. We're looking for credit default swaps. We're looking for spreads.
Stay short.
Try
and get what yield we can while remaining in very high quality.
Yeah. We definitely don't want to be in anything over cyclical there. For example, we at one point, not in the last year or two, but at one point we actually owned a department store, and we're like, get out of that. That was probably, I don't know, 5 years ago. So again, in the asset class itself, we have to be very specific. And then with cash, this is a hard one because about 5 years ago, Paul? Was it when when they changed the law?
It was 2016.
Yeah, in 2016, they changed the law that allows money markets to actually break the buck.
Right.
What
So
that means.
Little lesson. Break the buck means it can go less than $1. So your $1 of money market does not equal $1 of US currency. They essentially split money markets into two different kinds. So a little lesson here. Prime money markets, which only invest in treasuries. They can only hold treasuries.
In agencies, right?
I think it's mostly just treasuries. Okay. They might allow for a couple other government issued agencies, but very few. 5 or 10%. And then was it non-prime?
Yeah, not subprime.
Just non-prime,
not subprime.
Money market funds, which can go out on the risk curve more. So they can do overnight paper or super short-term obligations for corporate debt, all sorts of different things that are pretty much cash, but they don't have the same assurances behind them as treasuries. Now, the rules they changed were that non-prime can break the buck in times of high stress or volatility, meaning if there is a bank run or something and everybody's trying to pull their money out of money market funds, not only can they pay you less and lower their peg so it's not one-to-one, but they can also gate the amount you can take out at one time. So this was a pretty wild rule change that sort of went passed right through. Nobody really talked about it, but this is the reality and money market funds.
And which is why we went to prime. So you're going to find if some of you are with other broker dealers, we suggest that you look at what type of money market you have there, because our philosophy is money market, $1 in, $1 out. We don't want $1.50 out.
If you're trying to squeeze a few basis points of yield out of your cash, it's really not worth the risk that is attached to that.
So, another question that I'm sure this will bring to other people then, should we've mentioned our concern about the US Treasury, right? So let us be really clear. If there was a problem with the US Treasury, we have a big problem that's far greater than money. Okay, let's just get that right on the table. Okay, we have an issue that's far greater than money. Okay, so let's hope it never goes that route. That's the first thing we want to say to you.
And then it's relying on your social networks and your
exactly,
and that's what's more important.
Yeah, and then the second thing that we want to say is that please understand that the banks are equally and even more so at risk than your money markets, because now you have banks that have these portfolios that they're lending out, and we have some bankers on this call, so you all remember that. Oh my God, you remember what it was like in 2017. We worked together in 2017, 18. So, you know, you have to remember your money in the savings account in the bank is being lent out. And yes, there's FDIC insurance, but you know, FDIC insurance, we assure you that if there's an issue, it's going to hit the last place we think it would hit would be treasuries. So it would go banks and then all the way down, right? We said. And we do have somebody who asked that question, which is why we had to answer the question for you. So let's see. Now to go into the crypto stuff, I think we have. I'm going to ask for some water.
Okay.
Hold on a second.
All right, so we got some questions about cryptocurrency. So we're very well versed in that space, so we can sort of dig into some of those. So where do you see the value of Bitcoin and other cryptocurrencies a year from now? That's just, really, it's just guessing. But when we look at what this technology does enable, it is game changing. That said, this market is very, very much so tied to, it is the Wild West, right? But it's also very tied to risk on, risk off scenario. So if the general behavior of traders, of investors out there is risk aversion, this sector is going to get hit harder and stay down longer. A good example of this too is yes, Bitcoin, Ethereum, these things could be down, I think it's 60, 70% year to date. But also compare it to some of the speculative tech names, things like Zoom and companies like that were high flyers over the past month. They're down 85% plus some of these companies.
Yeah, we owned Zoom at one time. Thank God it's got out.
So where are we in a year from now? Really, it depends on what happens at the macro level. If inflation is tamed and generally people are more positive about the economy and environment, there's probably a good chance that all assets are higher a year from now. If these issues and structural issues are not resolved or not addressed in an appropriate way or in a way that the market likes, things could be lower a year from now.
So somebody, you know, just again, there's a couple things we want to talk about with cryptocurrency. Wild West, we've said that many times, it's the Wild West. The other thing is we have to liken it to what happened in the internet boom. So for those of you who were involved with the market, you know that a good 80% of the internet companies went out of business because, I mean, and we're talking thousands of companies, not just like a few, right? So it's the same thing here in the bear market in cryptocurrency is the bad actors, so to speak, aren't going to be there. Like it's good,
which is a good thing. Really.
Yeah, no, it's a good old fashioned recession.
It's such a disruptive technology that has so much potential to positively impact society and how we transact and how we interact. That it's almost like these kind of waves, they flush out a lot of the bad actors. Yeah. We've always said since the beginning that we believe something like 95% of the crypto space is junk. It's excess, it's scams, it's vaporware. It's not anything tangible, but that remaining 5% or so is really, really game-changing stuff.
Yeah. So like, you know, again, the infrastructure, those that are involved in infrastructure to us. And again, keep in mind that despite this correction, companies are still putting their money into Ethereum to build out infrastructure based on the Ethereum network. So, you know, do we like it? No, but to Paul's point, Zoom is down 85%. It's not necessarily worse, but it's equally as bad. So again, it's the Wild West, and you cannot put any money there that you cannot risk. You can't do it. It's just, that's why we always say don't put something there unless you're willing to lose every penny of it. Do we still have conviction with some of the ones that we believe in? Yes, yes, we do, because there is utility there. Yep. Okay, so do we have any other questions about cryptocurrency? Somebody brought up the point that Bitcoin hit a 200.
Yeah. So this is an interesting metric because historically, and it's only what, a 12-year chart or so. But historically, every time Bitcoin has hit that level, it has sort of marked the bottom. The big caveat there, though, is that the macro conditions, or there's never been a recession threat in the background at the same time. So, you know, people always say this time's different, but this time it actually really is that the economic backdrop is very different than every other time that it has hit that moving average in the past. So I wouldn't look at it as certainty, oh, it's definitely going to bounce from here. There's just some added risk into that point. Now, also too, the crypto market as a whole is no stranger to massive drawdowns. There's been many occasions, dozens of occasions where markets have dropped 50, 60, 70, 80+%. In 2007-8 run for crypto, the following few years, Ethereum was down 95% from its high. Went from 1,400 to 80, and then rallied to 4,000 plus after that. So what does that mean? This is a technology still in its infancy. It's going to go through crazy volatility, as we've always expected, but we do believe in some of the better positioned, fundamentally structured projects and plays in this space are appealing. But it's now a good time to get in. It's debatable. Markets could still go up or down in the space. A lot of it just really depends on what happens, in the back, like what that economic backdrop.
We can't answer that question. Is now the time to good time to get in. What we can say is this: we have to see a consolidation at the bottom before we buy anything.
And that applies to really any asset.
Anything.
Mm-hmm.
We are not interested in catching a falling knife, and we don't know if we're going to catch a falling knife or not. So it's so much better off from our perspective to just allow the markets, whether it's the crypto market or anything, to consolidate, to find a bottom before we buy. This is now a good time to buy. We cannot answer that question.
Let the data come in and really help guide us and point us to say, hey, look, this is the new data is coming in. It's showing us that the future might be leading this way or that way. And that's how we make many of our decisions from that.
Yeah.
All right.
Okay.
Well, we're here, so you can always email us, 413-236-2980, info@investwithwillow.com. Feel free to reach out anytime. We love talking about this stuff. We will make a recording available.
Thank you for all these questions. This was great.
Good
I love when you do this. Please do that anytime.
Recording should be available about a week from now or so on our website, investwithwillow.com/insights. All right. So thanks everybody for joining.
Everyone.
And enjoy your rest of the weekend.
Bye-bye.